Being a landlord isn't just about collecting rent checks. It's about running a real business, and like any business, you need clean books. Most landlords were never taught the basics of real estate bookkeeping, so today I want to walk you through the fundamentals in a simple, practical way. These are things that keep your rentals profitable, keep your taxes cleaner, and your stress levels lower. Hi, my name is Grace. I'm the founder of Brick and Ledger. We help landlords and real estate investors keep cleaner books, stay proactive with tax strategy, and organize their financials to empower them to make smarter decisions. Okay, let's get into the fundamentals. Fundamental number 1, security deposits are a liability and they ought to be treated as such. One of the biggest mistakes I always see is landlords treating security deposits, or more so recording them, as income. This easily happens because this money shows up in the same account as rent. So it just gets lumped in with everything else, even though these deposits are not income, they're liabilities. It's money you're holding in trust until the tenant moves out. In most states, there are even laws requiring you to hold this money in a separate account than your operating account. Recording them as income or leaving them in the wrong account not only is going to throw off your books and create tax problems, but it can also lead you down the path to some compliance issues. The right approach is to track these deposits separately, ideally in their own account, so you know exactly what you're allowed to keep and what's legally owed back to the tenant. Fundamental number 2, make sure you're breaking out your loan principal and interest. Mortgage payments. A lot of landlords record the whole thing as an expense, but only interest is deductible. The principal reduces your loan balance, so that's equity, not an expense. Separating the two gives you a clear image of your property's profitability and keeps your tax reporting clean. Fundamental number 3, track depreciation accurately. Depreciation is one of the biggest tax benefits of owning real estate. But for some reason, most landlords don't think about it until their CPA brings it up at the end of the year. Every property and major improvement should have its own depreciation schedule. Keeping this organized on your books makes sure that you're not missing deductions and that your financials reflect your true assets. Fundamental number 4, owner draws versus expenses. When you pay yourself, this is not an expense, this is a distribution. If you're mixing owner draws into your operating expenses, your property looks a lot less profitable than it actually is. Keeping these separate allows you to see your true performance and makes taxes a whole lot simpler. And fundamental number 5, vendor tracking and 1099s. If you pay contractors, handymen, any other service providers during the year, you may need to issue 1099s. The mistake most landlords make is waiting till January to figure this out. It is way better and easier to track these vendors throughout the year. Collect their W-9s up front so that when tax time comes, you're already ahead of the curve. You can track what you pay them on your books, and this makes issuing 1099s so much easier. So we'll stop there at 5, but there are so many other ones to cover, so make sure you subscribe for more. Basically, deposits aren't income, make sure you're breaking out your loan P&I, track depreciation, keep draws separate, and make sure you're prepared to issue 1099s. Get these right from the start to save yourself a headache. If you found this helpful, make sure you subscribe for more, leave a like, drop a comment of any questions you have or what you want to see next. And if you need any help, make sure you contact Brick and Ledger. All the contact details will be in the description. All right, I'll see you guys in the next one.